We go straight to business, though, staying on course. That is the word from the Federal Reserve just days away before the U.S. election. The Fed giving an upbeat view of the U.S. economy, but parts of the U.S. are still struggling. CCTV's Sean Callebs joins us with more. Hi, Sean.
Phil, the Fed met last couple of days, came out and made their announcement today, and the Fed is continuing to try and ease concern for homeowners. In many ways, people who make up the backbone of the U.S. economy, reiterating that it will buy $40 billion a month in government-backed securities until the employment picture here dramatically improves. Well, is the Fed's plan working? There are a host of critics out there saying the Federal Reserve has drifted away from its mandate. The Federal Reserve Bank, as we know it, dates back almost 100 years.
Initially, it was set up in response to some panics that we had had in the late 19th century and the first part, and particularly one in 1907.
Panic is a diplomatic term for a run on banks. People were terrified as Wall Street tanked that they would lose all the money they had socked away. The federal government had functioned without a central bank for more than 75 years, but it was time for a change. When Congress established the Fed, it did so giving the institution what it called three key objectives: maximum employment, stable prices, and moderate long-term interest rates. Basically, the Federal Reserve was charged with limiting the impact of a crisis in the banking world.
It certainly has evolved over time.
The first big metamorphosis was in the early 1930s, a horrible time when the United States was gripped in the Great Depression. The Fed now no longer served only to make sure there was enough money in the financial system. It became the principal lever in regulating the ups and downs of the economy to right the economic ship that drove the U.S. economy. It was followed by expansion and growth in the 1940s, 50s, and 60s. The Federal Reserve earned a place as a responsible entity. Then came massive inflation in the 1970s, a period economists give the Fed low marks. The economy and the Federal Reserve rebounded. In the 1990s, the financial markets began to spiral up. Analysts were glued to every word, every nuance, from former Fed Director Alan Greenspan.
I will tell you, it is unbelievably awesome.
Often when there are economic issues, right, for the country, the Congress, for example, the Senate and the House will turn to the Federal Reserve chairman or even the staff and ask him to testify on the subject.
But nothing prepared financial experts and the Federal Reserve for the economic collapse the U.S. is still struggling with. A historic recession that has seen the Fed make extraordinary, unheard of decisions in an effort to spark employment and ensure that the United States is one of the engines that drives the global economy. But many decisions have been met with controversy,
including rescuing individual financial institutions.
Right. Bailouts?
Yes, what you guys call bailouts. I prefer to call them rescues.
Many are still wondering why, on 2 consecutive days, the Fed chose to save AIG from financial ruin, but allowed Lehman Brothers to go under. Many critics say the Fed overstepped its authority. And speaking of firsts, the Fed's mortgage bond buying program marks the first time that the Fed has made an open-ended commitment to try and prop up the U.S. economy. Whether it's the Fed's job or not, it is an unparalleled effort to try and breathe life, Phil, into what is clearly still an anemic economy.
I don't remember a time when Fed decisions were this controversial. Certainly when Alan Greenspan was in office, that wasn't the case. In your report, you mentioned full unemployment, stabilizing prices, long-term interest rates. Well, the Fed, I guess, has been successful in parts of that, but the employment picture is still a big question mark. And there's a lot of critics out there saying, what more can the Fed do at this point? Haven't they already done more than enough?
Well, I think that there are a lot of critics out there saying that right now, and especially if you look at what they're doing now, $40 billion a month in buying back mortgage bonds. Interest rates are already at record lows or near record lows. What is it going to do, this is what critics are saying, to continue to sink that kind of money into buying these bonds? They are concerned that by putting this injection of cash out there, you run the risk of restarting inflation, perhaps causing another bubble in the securities market that could lead to the kind of problems that aren't going to be solved in months or even years again. So there are a lot of concerns out there. And a lot of folks also say, look at what the Fed has done over the years. Beginning back after the run on banks in 1907, everything it has done has been reactive. They've been reacting rather than proactive that see these problems coming up. But I guess you have to have the old 8 ball. Yes, points the way.
How times have changed.